Hey everyone, welcome back to the Web3 Daily. When I opened the charts this morning, my first reaction was, damn, this is brutal. Bitcoin hit a new high yesterday at around 124 and then bam dumped back down to about 118 like someone pulled the plug. Ethereum couldn't hold up either, dropping toward the 4.6k range. Overall sentiment just vanished overnight, and if you're wondering how bad it got, over $1 billion got liquidated in 24 hours. At peak hour, 500 million were wiped in just 60 minutes. Imagine going to bed bullish and waking up with your account blown. I've been watching the option wall and traders' tweets all day. It's clear the market's getting scared. Some major accounts already said they're hedging more and lightening long positions. You wanna know why this crash was so fast? I think it's two things. First, the macro slapped us in the face. The US released both CPI and PPI yesterday. CPI was slightly hot, but PPI, whoa. It jumped to 3.3% year-on-year, the biggest monthly rise in 2 years. That crushed the idea of a September rate cut. Stocks dipped, and Bitcoin just followed. Second, the market was over-leveraged. Everyone had been all in bullish these past weeks. When macro flips, leverage always pays the price first. That said, I'm not panicking. Structurally, this is just a healthy flush. No key support got broken. On-chain activity is still okay. Feels more like a macro shock meets long squeeze kind of move. Personally, I trimmed all my leverage, kept a few long spots. Right now, survival, greed. The Fed's next move will shape the next rally. Because let's be real, this is now a data-driven market. One bad number, and it nukes your wallet. Today's takeaway: don't be greedy. This isn't an emotion-driven market anymore. It's a patience game now. When I saw the PPI numbers yesterday, I was honestly stunned for a second. It wasn't just that inflation ticked up. It was the scale of that jump. A 0.9% month-over-month spike and 3.3% year-over-year. That just wrecked the whole rate cut narrative. If you look at the CME FedWatch tool, the odds for a September rate cut dropped from 40% to below 20%. The idea of 2 cuts this year, gone.
And here's the thing, we've been living in this quiet optimism for months. Markets weren't pumping like crazy, but capital was flowing in, slowly, steadily.
That slow grind up relied on the idea that macro would ease. Once that idea breaks, the dominoes fall fast. Stocks dip. Crypto follows. What makes it worse is this wasn't a technical sell-off. It was a reset in the Fed narrative. When that happens, technical charts kind of lose their power. Everyone's now watching for one thing: when will Powell give us a break? The craziest part, the emotional disconnect. I saw tons of posts on X showing massive liquidations, and honestly, a lot of those longs probably jumped in right after BTC broke 120k. Stack some leverage on top, and it's a bloodbath waiting to happen. But here's the thing, when I checked ETF, inflows, and on-chain data, I didn't see any panic exits. This wasn't big money leaving. It was over-leveraged bulls getting flushed. People were betting on macro easing early, but the macro's still playing hardball. So even though the price action looks rough, I'm not in panic mode. I'm waiting for the next CPI print or FOMC statement to see where the Fed's really at. Right now, the market's like still water quiet on the surface. But one poke, and it flips. And this PPI print, that was the poke. So last night I saw this alert on BtcTurk got hacked. My first thought was, damn, I've actually heard of that exchange. They're big in Turkey, not as visible in the Chinese-speaking world, but they've got real fiat ramps, real user volume. Apparently, the hackers drained multiple assets from their hot wallets: ETH, ARB, OP, AVAX, Matic, even Mantle and Starknet tokens. Total value lost, around $50 million. The platform instantly paused all deposits and withdrawals to stop the bleeding. I checked the chain. Those tokens got swapped to ETH fast, then split across addresses. Some tried to hit Tornado Cash. Some looked ready to cross chains, but the spread of tokens made it harder to fully obfuscate. And yeah, most addresses are now flagged. But here's what really matters. It's not about the hacker. It's about trust. The official BtcTurk statement said user funds are safe, cold wallets are untouched. But let's be honest, we've heard this before. MEXC Coin X, they all say that. What matters is, can users believe it this time? And let's not forget, this hack hit right as BTC was dumping. Combine fear with fear, and it starts feeling like we're back in bear market. PTSD, people get spooked, they move funds. They stop trusting mid-tier exchanges. This is how panic spreads. I already saw risk engines start flagging BtcTurk related addresses. Some exchanges may start freezing transfers or blocking withdrawals linked to those wallets. That causes real friction on-chain. So my advice, if you're holding these tokens, especially L2 versions, watch your liquidity, check your bridges, and use withdrawal whitelists. Split your assets across cold storage if needed. Safety first, always. There was another thing I saw yesterday that caught my attention. The US Treasury dropped a hammer again. This time, they're targeting a Russian-backed stablecoin network. There's this ruble-pegged stablecoin called A7A5. Never heard of it? Same. But suddenly, it was processing over $1 billion per day on-chain. That raised a lot of eyebrows. Turns out, it's linked to Russian banks and financial entities under sanction. They've been using A7A5 to facilitate cross-border payments. And let's be real, probably some money laundering too. The tokens move through Tron and Ethereum, and the exchanges they go through, not your cleanest ones. Platforms like Garantex and Grinax, already sketchy, were core hubs for this network. So the US Treasury's OFAC division came in hard. They sanctioned everything tied to a 7A5 wallets, operators, nodes, even intermediaries. They're not just stopping this one coin, they're sending a message to the whole ecosystem. This isn't about Russia alone. It's about drawing the line. If you're building stablecoins that bypass dollar oversight, you're now on notice. Right now, this doesn't affect everyday traders. But if you're building anything cross-border DeFi, pay rails, swaps, you better start checking your token lists. If one of your supported coins ends up on a sanctions list, and your app touches it, that's a regulatory nightmare. If I were running a wallet, a bridge, or a DeFi aggregator, I'd be auditing every token contract I support right now. Because in 2025, it's not just about does this coin work, it's does this coin get you banned? This next one caught my eye because it might actually shift how DeFi frontends operate in the US. And who gets to build them? A16s and the DeFi Education Fund just submitted a proposal to the SEC asking for what they're calling a front-end safe harbor. Basically, they want to carve out a legal exception for certain dApp interfaces, so those teams aren't labeled as broker-dealers. Right now, the SEC's attitude is kind of vague. If your website lets users connect their wallet and execute a trade, there's a risk they'll say you're operating as a broker. That means licensing, compliance, legal headaches, but A16's proposal says not all front ends are the same. If your site doesn't custody funds, doesn't make trade decisions, doesn't suggest assets, and the code is immutable, it shouldn't be considered a broker. Now, I don't think the SEC is going to greenlight this tomorrow, but the fact that A16s and DEF are even proposing this, that shows the space is growing up. We're not just waiting for regulators anymore, we're actively trying to shape the rules. It also signals a regulatory tone shift. Not everything on-chain needs to be boxed into traditional finance categories. Some tools are just that, tools. Yesterday, we saw something on the New York Stock Exchange that fell straight out of a bull market. Bullish officially went public, and it popped hard. The IPO priced at $37 per share, but after listing, it surged over 200% at one point. Even after some pullback, it closed way above the initial price. All in all, they raised over $1.1 billion. That's huge. And more importantly, it sends a clear message. Wall Street is once again open to crypto companies. The right kind, at least. From a macro view, this is Wall Street recalibrating how it sees crypto. Less about token hype, more about cash flow, compliance, and narrative. If your numbers check out and you can tell a story, there's capital waiting. If you've been watching Ethereum lately, you probably noticed something big. ETF inflows are picking up, and they're not just trickling in, they're pouring in. Last Friday through this week, ETH spot ETFs, mainly BlackRock's ETHA and Fidelity's FETH, have been stacking massive inflows. One day alone, $1.02 billion. That's a record. The next day, $729 million. In total, we're talking nearly $2.3 billion in just a few days. This isn't some yay. We launched an ETF moment with no follow-through. These are real inflows, real capital, and it's happening while Bitcoin is chopping at local highs. To me, the key takeaway is this. Ethereum's not just some smart contract chain anymore. It's becoming a legit, regulated, institution-grade asset. That changes everything. Here's a headline that's flying under the radar, but honestly, It's a big deal. Citi is getting into the stablecoin game. Not just talking about it, they're actively building. According to Reuters, Citi is evaluating 3-place custody services for stablecoin reserves, enabling stablecoin payments for enterprise use cases. Custody for crypto ETF, underlying assets. They didn't outright say we're launching our own stablecoin, but the language from XX was close, and they've reportedly started testing some of this with partners. This isn't about decentralization anymore, it's about merging systems. But for us, that's actually bullish, especially if you're in market making, arbitrage, or liquidity games. Banks bring capital, standards, predictability. So if you're managing portfolios or building apps on-chain, start watching these banks closely, because soon your counterparty might not be some anonymous wallet. It might be Citi's on-chain settlement node. So today's vibe, one word, conflicted. The market's strong. ETFs are flowing in. Projects aren't rugging. But the price, still pulling back. You want to buy the dip, but macro's pressing down. You want to stay safe, but then you risk missing the next leg. This is peak emotional whiplash. I'm personally sitting half in, waiting on the next macro dataset, especially the next FOMC tone. If the Fed softens, that's the spark for a real move. If they stay cold, we wait. But either way, don't rush. In markets like this, the fast hands get chopped, the slow hands survive.